Inflation may prompt Fed to dial back rate cut outlook. U.S. central bankers are not expected to cut borrowing costs this week, but their new economic projections may be a wild card, potentially signaling fewer interest rate cuts and a later start to the policy easing they previously had estimated. Now, keeping interest rate at the current high levels for a longer period of time could have big implications for American households and businesses, especially in a presidential election year when the state of the economy is already central talking point for President Joe Biden and his Republican challenger Donald Trump. Now, market bets still point to the Federal Reserve's June 11 to 12 meeting as the most likely stop for reduction to the central bank's policy rate, which has been in the 5.25% to 5.50% range since last July. But with inflation still running well above the Fed's 2% target and coming in stronger than expected in the first 2 months of this year, traders are pricing a 40% chance that the first rate cut only happens at the July 30 to 31 meeting. Bets in the financial market also point to an end of 2025 policy rate in the 3.75 to 4% range, a quarter of a percentage point lower than Fed policymakers forecast in December. 2 months of higher inflation readings is too soon to declare that all is lost, but it certainly raises the risk that you have a little bit more of an inflation problem. And in that case, it makes sense to be cautious, said Jeremy Schwartz, senior U.S. economist at Nomura Securities. You have to consider the possibility that it will take a longer period of restrictive policy. Nomura is among the minority, but a growing number of forecasters who believe Fed policymakers this week will trim the number of the anticipated rate cuts this year to just 2.25 percentage point moves from the 3 that U.S. central bankers projected in December. A report last week showing consumer price inflation accelerated 3.2% in February from 3.1% in the prior month is not going to give Fed policymakers greater confidence that inflation is moving sustainably towards their 2% goal, the bar that set in January for cutting rates. They were hoping for better, clearly, but I'm not sure they are completely surprised by this, said Kathy Polchanchik, chief economist at Nationwide, who is among those who think Fed policymakers will stick to the quarterly forecast issued in December. I think it's probably it just validates their view that, yes, it's prudent to wait and see. Despite signs of cooling, the economy remains strong. The unemployment rate at 3.9% in February is up 0.2 of a percentage point from the start of the year, but still below what Fed officials believe is sustainable in the long run. Businesses added 275,000 jobs last month as well. The main message from them is they can be patient, said Oscar Munoz, chief U.S. macro strategist at TD Securities. If the median expectations for this year does shift to 2 rate cuts, Munoz said, it would suggest they see the recent strong inflation reading as a game changer. Munoz expects the Fed to start cutting rate at every other policy meeting or once every quarter, which he said implies a likely delay in the start of the policy ease into September if the central bank reduces the number of rate cuts in 2024 to 2. Either way, Munoz expects policymakers to project a slightly higher inflation rate for 2024, perhaps 2.6% by the Fed's preferred inflation measures. The personal consumption expenditures price index up from 2.4% in December. Balance sheet. Now, Deutsche Bank economists likewise see an upside risk to the Fed's inflation forecast, and like Munoz, they expect the Fed on Wednesday to stick to the projection of 3 rate cuts for this year with a start in June. But they also believe sticky inflation likely means central bank policymakers will trim the number of rate cuts they forecast for 2025 to 3 from the 4 seen in December. The main message from the March summary of economic projections should be that the Fed will have little tolerance for further upside inflation surprises, and if they were to occur, expectations for policy easing this year will be dialed back, all else being equal, they wrote. Other economists cautioned against reading much at all into the median projections. Gregory Dacko, chief economist at EY, expects the median forecast for rate cuts to downshift to 2 on Wednesday, but for a resumption of soft inflation reading to require a total of 4 reductions in borrowing costs this year. By contrast, Tim Dye, chief U.S. economist at SGH Macro Advisors, argues that as many as 8 of the Fed's 19 policymakers could pencil in fewer cuts than they did in December without shifting the median. Most analysts expect fewer changes to the Fed's policy statement on Wednesday, but they see more of an emphasis on the need for careful adjustment in Fed Chair Jerome Powell's post-meeting press conference and plenty of hedging around the timing of rate cuts. Many market participants are also hoping Powell provides a better sense of when the Fed could eventually stop shrinking its roughly $7.6 trillion balance sheet. To be ready to announce the details of that plan in May and begin slowing reductions in June, as Yelena Shilatieva, senior economist at BNP Paribas, predicts is a likely timeline. They need to do a lot at this meeting, she said.